Chapter 9, Employee Expenses and Deferred Compensation. So this is just a slide to give you an idea of the different types of employee expenses. And we're basically at first looking at the difference between reimbursed and unreimbursed expenses. So basically, reimbursed would mean fully, you have an employee expense related to your business, trade or business as an employee working for someone else. This expense is then reimbursed by the employer. Okay, so basically, this reimbursed type is basically treated as if you didn't incur the expense and you didn't receive the reimbursement. So it's as you see there from the bullet point, the employee can deduct for AGI if amounts were taken into income. So basically, if you included the amount that the reimbursement came as part of your income, then you can take a deduction for that amount to basically cancel out the effect of that reimbursement. Now, obviously, if it's unreimbursed, then you have expenses incurred by the employee. They're not reimbursed. At that point, an employee can deduct up to or subject to the 2% miscellaneous deduction floor. So basically, you add this to the other miscellaneous deductions, you take that 2% floor away, and that leaves you with your from AGI deduction related to these employee expenses. Okay, we also need to determine the actual relationship that exists between an employer and an employee. So this is basically where you're determining whether an employee is actually an employee or is an independent contractor. So obviously there are different tax rules that apply based on whether you're dealing with an employee or dealing with an independent contractor. Now, obviously, as an employee, the employer has to pay certain employment taxes on behalf of the employee. A portion of Social Security, unemployment, these are not required of the employer if they're paying an independent contractor. But they also don't get the deductions associated with paying an employee. Similarly, an employee would have to shoulder more of the burden of those employer payroll type taxes if they're being paid as an independent contractor. So depending on the desires of the employee and the employer, that could be either beneficial or detrimental to be classified one way or the other. Now, according to the IRS, basically, if the employer is able to not only mandate what job you do, but also how you do it, if receiving payment, if there's no risk associated with the employee performing the duty as far as getting paid for it, that tends to say that there's an employee-employer relationship rather than an independent contractor relationship going on. This is an area that is litigated very often. The IRS takes action very often in this area because people, generally employers, like to classify employees as independent contractors, even if they may not be. There is currently an ongoing case dealing with Uber, where Uber, I'm assuming most of you know, or hopefully all of you know what Uber is, but basically a substitute for taxi system, where according to Uber you have a bunch of independent contractors driving their own vehicles, and Uber just handles dispatching those vehicles to the various locations to provide ride services for people. Now, the IRS claims that this is an employer-employee relationship, and Uber claims that it is an independent contractor relationship. And various independent contractors for Uber are also claiming that this is an employee-employer relationship. So again, unreimbursed employee expenses, you have to be classified as an employee to take these into consideration. But if you are able to classify yourself as an employee and you have these various types of employee expenses, they go into this group of miscellaneous expenses that's subject to the 2% floor, and you see the various components of those miscellaneous expenses in this slide. Based on how you're classified, there are different laws associated or rules associated with the deductibility of travel expenses. So as a self-employed individual, this would also include you working as an independent contractor, because you'd be classified as self-employed in that case. These types of expenses are deductible for AGI, so they're above the line deductions, and there's no 2% floor. So these are treated as business expenses, and that goes to kind of the profit or loss of your business. As an employee, they're deductible for AGI only if they're reimbursed and the reimbursement is included in income, similar to the other discussion we just had of reimbursed employee expenses. If they're unreimbursed, they're deductible from AGI, but they are subject to the 2% floor. And then finally, if they're considered personal travel expenses, obviously no deduction is allowed at all. In order to claim the travel deduction, if you're able to claim it at all, expenses must be business related. If not, that's just considered a personal expense like we just talked about. And the other component is the worker must be away from tax home for a sufficient duration to require sleep before returning home. And this is another area that has been litigated in the past. And you can see this in the next slide here. The away from home requirements require a determination of several components. Where is a taxpayer's home? You have to be able to establish where the home is to determine if you're actually away from the home. Is being away from the home a temporary situation, an indefinite situation, or a permanent situation? If it is an indefinite or permanent situation, then the IRS does not consider travel expenses as deductible. They consider that you've actually changed your home. Okay. The other difficulty that has been litigated, and there's no great answer for yet as far as a black and white answer, is defining overnight. And it's actually not defining overnight per se, but defining when is sleep required. So there have been cases where the taxpayers claimed the travel expense deduction because they have been away from home for a very long day, say like a 16-hour day. And they say that in order to be able to get back home, they had to sleep for, let's say they slept from like 10 p.m. to 2 in the morning and then drove the rest of the way back home. Well, you can see there that creates or falls kind of within a gray area, and that is something that has been litigated before, but is still not completely, there's no set and dried, okay, if you've been gone 18 and a half hours during the day, and we consider that away from home on a temporary basis, that's sufficient to be require sleep. None of that has been officially decided. But obviously the longer that you're away, the more likely it is that you would be able to win if there was a dispute over whether or not that would qualify. Again, like we said, travel expenses that are temporary are deductible, but if it's an indefinite situation, then the IRS considers that your home now becomes wherever your workplace is, and travel expenses are no longer deductible. Okay, so some areas where this has occurred is like if you work in a job where you go to work Monday through Friday at a different location than where you normally live, and let's say you have like a temporary, you rent an apartment for the work week, or you stay in a hotel during the work week, that can kind of help decide. But if this is for a long period of time where you are working the schedule, the IRS will say that your home is actually where your workplace is. If it's for a certain period of time. So usually this ends up kind of centering around a 1-year period. So if you believe that this is going to be at the outset, if you have reason to believe that this arrangement is going to exist for a year, then you are likely to be considered in an indefinite situation where your travel expenses are not deductible. Likewise, if you become aware that, let's say, you have an arrangement like that, and 6 months into the arrangement, you become aware that it will likely last more than a year, whereas before you thought it was only going to last 6 months. Now you realize it's likely to last longer than a year. As soon as you made that realization, the IRS is likely, or had reason to, if you had reason to make that realization that it's likely to last for longer than a year, at that point the IRS stops allowing you to deduct your travel expenses. But for the entire amount of time that you believed it was only going to be a 6-month or a 3-month period, you are still able to take those deductions. So again, tax, though a lot of people would think of tax as being more of a science in that you should be able to come up with an exact answer, it still requires a lot of interpretation based on case law, and there's some art involved with it as well because of that, because you have to kind of determine, based on what you've seen, what's most likely to be the outcome if it were to go to court again. So generally, other travel expense limitations, these are all areas that are going to kind of raise red flags. And there, I'm not going to get into the minutia associated with these, but generally, if you're traveling away from the United States, it's going to be looked at a lot more closely, and there's more strict guidelines. Also, if you're on any type of luxury water vessel, which kind of would encompass here conventions or meetings on a cruise ship, or if it's just what you would consider a general education trip, like there's no specific like class or education going on, but you're just saying, hey, I'm traveling to the French Riviera to get a better understanding of the French culture because I have a business that operates in France. Well, they're going to say, well, for any of these, these are basically looked at with more scrutiny because it's very likely that these situations are going to involve abuse of the expense deduction, because the IRS is going to say, oh, it's more likely that these are associated with just personal or pleasure travel, so we are going to be less likely to allow it in those situations. Again, as always, for AGI and from AGI can be significant issues. For AGI, it has to be a trade or business. There has to be production of rent or royalty income or reimbursed employee expenses if properly accounted for to employer. From AGI, all of those would be subject to that 2% floor that it has to be above, and can include unreimbursed employee expenses, Section 212 investment expenses or portfolio expenses basically, and other medical expenses that are subject to that 2% floor. Now, when we talk about transportation to and from work, generally transportation to work and from work are not deductible if this is just to and from your office on a day-to-day basis. Now, there is an exception if you work more than one job and you have transportation from job 1 to job 2. You're allowed to deduct the expenses associated with the transportation to and from job 1 or from job 1 to job 2. Okay, so you would basically determine the distance between job 1 and job 2. That's the amount of miles that you would be able to deduct as a business-related travel expense. Now, if you decide between job 1 and job 2 that you're going to go home to your tax home and then go from your tax home to job 2, you are still only allowed the deduction related to the distance between job 1 and job 2. Or in other words, in this slide, instead of from job 1 to tax home's 5, plus tax home to job 2 is 8, so 13 miles. Instead of deducting expenses related to 13 miles, you would only be able to deduct expenses related to the mileage as if you had gone directly from job 1 to job 2. This does not mean that you had to go directly from job 1 to job 2, but just that that's the mileage that you're allowed to deduct. In addition, when you're talking about expenses related to an automobile, you have the option of either taking the actual expenses, and you see the categorical list there, or you can take the standard deduction, which at this point is 57.5 cents per mile, and in addition to that, you are allowed to take parking tolls, interest expense, and personal property tax expense associated with that, in addition to the standard rate. Okay. Of course, those would also apply to if you were taking actual expenses, but since the standard rate is supposed to encompass, basically the standard rate is supposed to encompass everything that you see listed under this actual side or an IRS estimate at those expenses, so that you don't have to specifically determine the percentage of time that the vehicle is used for business-related expenses, and you can just look at the mileage and calculate it that way. This is just a flow chart that will help you determine meal and entertainment expenses, and you just follow the flow chart through, and it's pretty self-explanatory there. This is with respect to entertainment facilities and club dues, like for instance, if you keep a country club membership for business purposes, you see here that in general, the dues associated with those memberships are not able to be deducted. As far as business gifts go, these are generally deductible up to $25 per donee. Anything above $25 is disallowed as a deduction. These are not subject to a 50% reduction, as you would see with some of the entertainment and meal expense items. And employee achievement awards that are under $400 per individual are deductible, but they have to be related to some already established achievement guidelines. You can take a look at this slide. I'm not going to talk too much about it. Like to just skip over to, that goes along with the last slide a little bit, but I'd like to skip over here to the requirements for moving expenses. And in order for moving expenses to be deductible, there are two components that must be met. First, the new job must be greater than 50 miles from the old residence. This is the old residence related to the old job. Then employee expenses, or employee must be at the new location for at least 39 weeks during the 12 months following the move. So you can't kind of hop from place to place without that amount of time passing. And the other time requirement is 78 weeks during the first 2 years. So basically 39 weeks during the first year and 78 weeks during the first 2 years. That doesn't mean 39 weeks during each of the first 2 years. So for instance, you could have all 52 weeks of the first year and then 26 weeks of the second year, and that would meet your requirement there. These are the items separated out associated with moving expenses that are deductible versus non-deductible. You can take a look at that. On that two-pronged time and location test, you don't have to meet those if you become disabled, unable to work, you die obviously, or if you are terminated against your will. If you meet all those qualifications, this is a 4 AGI deduction, and you see it right there on the 1040 form. Moving expenses paid by the employer are excluded from gross income as long as they are deductible under Section 217. Any non-deductible moving expenses paid for, so in other words, taking back a look at these, anything in this category that is paid for by an employer must be included in employees' wages and cannot be deducted by the employer. These are just some of the general or some of the exceptions to the general rule associated with non-deductibility of educational expenses. So that lets you know that in general, educational expenses are non-deductible with some of these exceptions, which we'll look at some of them here. So there is a general ability to deduct educational expenses basically as an unreimbursed employee expense. But this exception provides that it basically allows you to take it as a for AGI deduction if you meet these requirements. The education must be used to maintain or improve skills for your trade or business, or the expenditure is required by the employer or imposed by law. Not deductible if the education qualifies the taxpayer for new trade or business, or there are minimum education standards required by your employer to receive employment, and this expenditure is related to you meeting that minimum threshold. So that seems a little confusing there, but basically if your employer requires that you do this, it's deductible, but not if it's a blanket requirement for your position that you have to have a minimum level. Let's say you have to have a bachelor's degree to meet the minimum education requirements for employment here. That would be non-deductible. But if your employer says while you're working, hey, everyone in this field or in this position now needs to go out and do 3 hours of continuing education in this subject in order to stay current, that's how those two would be distinguished. The home office expense criteria is pretty straightforward, so you can just take a look at those on your own. And we'll move on to some types of deferred compensation plans and other retirement vehicles. Okay, so these are some examples of those plans based on some distinctions as qualified plans. These are basically for non-self-employed employees, so qualified versus non-qualified, which we'll talk about in a little bit. And then some plans that are specifically set up for self-employed taxpayers. So these are various types of qualified plans. Well, we'll talk about some of the effects of being a qualified versus non-qualified plan as far as tax consequences to employer and tax treatment for employees as well. But qualified pension plans are either contributory or non-contributory, defined benefit or defined contribution plans. You have these various profit sharing and stock bonus plans. So under the qualified pension plans, you either have a defined benefit plan, and this basically, it's called defined benefit because regardless of the amount that you pay into the plan, there's a defined benefit that's usually calculated by years of service and your salary over a certain period of time during those years of service. So usually this is like, okay, if you work for 20 years, then you get 60% of your most recent 3 years, an average of your most recent 3 years salary. You will get 60% of that for the rest of your life. Okay, so that would be an example of a defined benefit plan versus defined contribution plan. Instead of defining what your end benefit is, you have a defined contribution that the employer and or employee make each year into the plan. That money gets invested at the end of the day or the end of the work life or whenever this money is extracted. Instead of getting a certain amount every year, you have a big pot of money that you are able to withdraw based on your basically annuity schedule there. 401k plans are the most common type of profit-sharing plans. To be considered a qualified profit-sharing plan, there must be a definite formula to allocate employer contributions. Employees must have either the option to take compensation in cash or contribute to the plan, and the employer does not have to contribute annually but is required to make substantial and recurring contributions. Then we have these Roth-type profit-sharing plans, and these just basically take on Roth-type characteristics, which basically means contributions are with after-tax dollars, but withdrawals and the buildup of money within the plan are tax-free. Okay, so it's basically, these are back-loaded plans where you receive the tax benefit at the end or when the withdrawals are happening or distributions are happening. Qualified stock bonus plans are a specific type of defined contribution plan, but the investments are from the employer are in company stock, and you see some of the requirements there. Now, non-qualified plans, or I should say the difference between qualified and non-qualified plans, go to mainly the fact that qualified plans are not able to discriminate in favor of more highly compensated employees. So in other words, qualified plans are not a good mechanism to pay bonuses or additional compensation to your company executives. Okay, if you want to do that, you're generally limited to non-qualified plans. So some common forms of those are executive supplemental deferred compensation plans. These are taxable to employees upon distribution, but are basically deferred for a certain period of time. And stock rights or transfers where there is a significant risk of forfeiture. In other words, it doesn't vest immediately, and there's a significant chance that you're not going to ever get it. Non-qualified plans, like we said, are not subject to the discrimination rules that we talked about already. They have to have restrictions on transfer of plan's benefits to employee, but also employee can delay recognizing income because of those restrictions until the money is actually distributed. For the employer to take a deduction, there's no deduction granted to the employer until the employee is forced or decides to recognize income. So sometimes the employee is able to recognize the income immediately. In that case, the employer is also able to recognize the deduction in the same year that the employee recognizes the income. I'm not going to talk too much about employee stock option plans. We'll just take a look at some of the self-employed individual plans here. What you'll see from a lot of these is the maximum contribution ends up being $53,000 currently, or 25% of earned income. So that's a similarity of a lot of these plans. We're not going to get into a lot of the specifics other than just knowing that these plans are out there, and you can take a look at the various some of the specifics of these plans within your textbook. There's a chart there that shows some of the specifics, but getting into the minutiae of these plans is kind of beyond the scope of this class. IRAs are a very common type of retirement account. You've got traditional IRAs, Roth IRAs, and then you have Coverdell education IRAs that are limited to higher education and sometimes primary and secondary education. And all of these have various stipulations and requirements associated with them. This is a pretty good chart that shows some of the specifics there. Again, getting into the minutia of tax planning around IRAs in complicated cases is a little bit beyond the scope of this class. But some of the some of the components that are fairly straightforward are the fact, in general, a maximum contribution into a traditional or Roth IRA are these limits of $5,500 going up to $6,500 once you pass a certain age, usually 59 and a half, grant you an additional amount there. There's also an additional amount for married filing jointly if the spouse is not working that you're able to take between the two spouses. But these, other than the Roth IRA, basically with the traditional deductible IRA, and this top one is the non-deductible IRA, but with the deductible IRA, you're able to deduct the amount that you're putting in that for the year, but the deductible IRA is subject to phase-outs based on AGI and the existence of an employer pension plan that would basically disallow that. Now, those don't exist for the non-deductible traditional IRA, and essentially they do exist, but they're essentially canceled out by some of the provisions of a Roth IRA. But under both of those categories, the initial contribution is not deductible. Okay, so that would be the big difference there. Okay. So this is the slide I was talking about where you are granted the ability to contribute as a married filing jointly spouse, essentially doubling the amount that you're able to contribute there. This slide talks a little bit more about some of the, actually the next two slides talk a little bit more about some of the provisions of a Roth IRA. These are increasingly more popular since this is a newer advent into the IRA market, and are popular basically because you are able to delay the tax benefit into future years, pretty much allowing you to have a better withdrawal when you are able to take them out, and you don't have to worry about taxes there. Those are the phase-out thresholds. Let's see. I'm not going to talk about that too much. The Coverdell Education Savings Account, you can basically establish this in someone else's name if you want. Doesn't have to be a relative. But the maximum amount that you're able to contribute is $2,000 per year per child, and it has to be a child that's under the age of 18. Moving on to health savings accounts, these are also a relatively new advent. You can only use these if you're in a high deductible insurance plan. Contributions to this are for AGI. The amount within the health savings account is not taxable income when paid, as long as it's going to pay for a qualified medical expense. If it gets used to pay for a non-qualified medical expense, then the amount becomes taxable income. In order to qualify for an HSA, like I said, you have to be covered under a high deductible plan. You cannot be covered under, so let's say you're covered under two plans. None of those basically can be a non-high deductible plan. You can't be claimed as a dependent for someone else, and you can't be basically Medicare aged.